Welcome to Course 03 of the MaxLife Commercial Academy. I am Ryan Solberg, real estate broker and founder of MaxLife Commercial here in Central Florida. License number 335351. In this course, we are going to tackle the documents that separate sophisticated CRE investors from the ones who get burned: the rent roll, the T-12, and the operating statement. By the time we are done, you will be able to pick up any deal package, flip to the financials, and immediately know what to look for and what to question. Let us get into it. Every CRE deal package will contain some version of these three documents, and each one serves a distinct purpose. The rent roll is a live snapshot. It shows you who is in the building right now, what they are paying, and when their leases expire. The T-12 is historical. It shows you what actually happened over the last 12 months, warts and all. And the operating statement, or pro forma, is forward-looking. It is the seller or broker telling you what the property can do under ideal conditions. Here is the critical thing to understand. Sellers have every incentive to hand you the rosiest version of each document. They will give you a pro forma that assumes full occupancy and top of market rents. They will hand you a T Chapter 12 that excludes the month a roof caved in. Your job as a buyer is to demand all three, reconcile them against each other, and find where the story breaks down. At MaxLife Commercial, we teach our clients to treat every deal package like a puzzle where some pieces are deliberately hidden. By the end of this course, you will know exactly where to look. The rent roll is the first document I open on any deal, and I read it the same way every time. Start with the basics. Who is in the building? How much space do they occupy? And when does their lease end? Then I build what I call a rollover map. I plot every lease expiration on a 12-month calendar and look for clusters. If 3 out of 5 tenants are all rolling in the same year, that property is not a stabilized asset. It is a repositioning play, and the price should reflect that. Next, I look at rent levels. Pull comparable rents from similar spaces in the same submarket. If a tenant is paying 15% above market with no escalation, that rent does not renew at the same level. The pro forma assumption of flat income is fiction. I also flag month-to-month tenants immediately. Sellers love to count them as occupied because technically the space is generating income. But a month-to-month tenant can leave in 30 days, and you cannot refinance or sell the property with that instability on the books. Finally, always reconcile the rent roll square footage against the actual lease documents. I have seen rentable area inflated by 5 to 10% on older properties. That changes your price per square foot calculation and your reimbursement math. The T-12 is the most honest document in the deal package because it is based on what actually happened. Cash that actually came in, bills that actually got paid. But honest does not mean clean. My job when I open a T-12 is to normalize it, meaning I strip out everything that will not repeat and add back everything the owner conveniently left out. The 4 adjustments I make on every deal are these. First, remove one-time income events. If a tenant paid a lease termination fee in April, that is not recurring revenue. It is a lump sum that made 1 month look great and will never appear again. Second, add back expenses the owner did not pay themselves. Self-managed owners frequently skip a management fee because they manage it personally. But when you buy this property, you will either manage it or hire someone. Either way, it costs money, and a market management fee of 4 to 6% of effective gross income needs to be in your model. Third, look for seasonality. A strip center anchored by a tax preparer will have a a wildly different February than August. Do not let a single strong quarter mislead you. Average the income over all 12 months. Fourth, think carefully about vacancy credits. If a space sat empty for 6 months, the T12 understates what the property can earn, but only credit it at market rent. If you have evidence, the market will actually absorb that space at that rate. After all four adjustments, you have normalized NOI, and that is the number you apply your cap rate to. Operating expenses are where seller statements get the most creative. The goal is always to show the lowest possible expense load to make NOI look as high as possible, which in turn makes the asking price look justified. Let me walk you through the 8 categories I verify on every deal. Property taxes first. Always pull the county tax record directly. I have seen sellers quote the prior year tax bill on a property that was reassessed after a sale, meaning the buyer walks into a tax bill 30% higher than the T12 shows. Insurance is next. Self-insured or underinsured owners will show almost nothing on this line. Benchmark it to your own insurance. Quotes early in due diligence. Management is the big one. If the seller manages themselves, there is likely zero management expense on the T12. Add it at market rate regardless. Maintenance is often depressed because sellers defer non-emergency repairs in the 12 to 24 months before listing. Ask for a capital expenditure history going back 5 years. Capital reserves are almost never in a seller statement. For older retail or industrial, budget 15 to 25 cents per square foot annually. And always verify which utilities are owner paid versus tenant paid under the existing leases. This is especially important on older gross leases where the split may not match the pro forma assumptions. The gap between a seller pro forma and normalized actuals is where deals either make sense or fall apart. I want to walk you through exactly how this plays out in practice. A seller lists a 10-unit strip center at a 5 cap. Their pro forma shows $800,000 in gross income and $500,000 in NOI. You look at the T12. Actual collected rents were $680,000 because one unit was vacant for 4 months and 2 tenants paid late. Actual operating expenses were $360,000, but that includes zero management fee and zero capital reserves because the owner manages it himself and has not replaced a roof in 15 years. Now let us normalize it. Add a management fee of $34,000, 5% of gross. Add capital reserves of $18,000. Suddenly your NOI drops from $500,000 to $448,000. At the same 5 cap, that is a value of $8.9 million, not $10 million. That is a $1.1 million difference from a document that looked fine on the surface. This is why we always build our own model from the actuals and apply our target cap rate rather than accepting the seller cap rate. At MaxLife Commercial, we walk our clients through this reconciliation on every deal before they make an offer. The formula is simple. Your offer price equals your normalized NOI divided by your target cap rate. Do not let anyone tell you otherwise. I want to be clear that not every seller using these tactics is acting in bad faith. Some of this is just standard deal presentation. Everybody leads with their best foot forward, but as a buyer, you need to know these 6 moves cold so you can identify them, quantify their impact, and either walk away or negotiate a price that reflects reality. Above market rents are the most dangerous because they look like a strength. A tenant paying $20 a foot when market is $15 a foot makes the rent roll look great until you realize that lease expires in 18 months and the tenant is already shopping for cheaper space across the street. Expense omissions we covered in the last slide. Always add management and reserves regardless of what the seller shows. Pro forma occupancy on vacant space is another favorite. A seller will say the property is 90% occupied on an economic basis, but two of those units are empty, and the income is a projection based on asking rents that have not been leased. That is not income, that is hope. Short lease windows are subtle but important. If you are buying a property where the anchor expires in 22 months, you are effectively buying a value add play at a stabilized price. Finally, always pull your own sale comparables. Cap rate markets move fast, especially in Central Florida. A comparable from 2 years ago may not reflect where buyers and sellers are transacting today. We can help you pull current comps through our network at MaxLife Commercial. Reach us at 321-586-2121. That wraps up Course 03, reading CRE financial statements. You now have the framework to open any deal package, pick apart the rent roll, normalize the T-12, and pressure test a pro forma against actual performance. These are the skills that separate investors who get the deal right from the ones who inherit someone else's problems. I am Ryan Solberg, broker at MaxLife Commercial, license number 335451. If you are analyzing a deal right now and want a second set of eyes on the financials, give us a call at 321 586 or visit us at maxlifedevelopment.com/academy. The next course in the series is Financial Analysis for CRE, where we go deeper into IRR, equity multiples, and building a full hold period model. See you there.